Debt to income ratios, CCCFA, tax changes, interest rates, all of this is going to be, there's going to be a lot of changes. So I'm going to get into some of the detail and a little bit of a deeper look into the monetary policy statement as well that was released by the Reserve Bank. So just to start off, debt to income ratios are here. They kick off 1st of July. What does it mean? It means that there's an upper cap on how much you can borrow, 6 times your gross income, and surprisingly 7 times for an investment property. Okay, so does that mean you can borrow 6 to 7 times? No. At the moment, with the current test rates, the banks are probably lending somewhere around 5 times or less. So 6 to 7 times sets the upper cap. But it probably, since it sets only the upper cap, it probably won't have a real big impact on what you can do right now. It may in the future though. Remember, while these DTI caps have been released, the banks are allowed, the Reserve Bank does give them an allowance of 20% of the consumers to go outside these rules. Okay, and again, I don't think that'll have much of an impact now, but maybe later on. The banks may need to use that for certain situations, like self-employed income, family groups, borrowing together, or having joint debt on another property. I'm guessing that's where they'll use that. Now, they are also opening up, as of 1st of July, the deposit requirements a little bit. So expect more first home buyers, so 20%. So the banks will be allowed to have 20% of their lending, new lending, for clients with less than 20% deposit. Right, so that's an increase as well. So expect a few more first home buyers, as they tend to have lower deposits. Investors, the deposit and equity requirement for investors is also dropping from 35 to 30%. Okay, so if you're just on the cusp or the verge of getting enough equity to buy an investment, you might get there sooner. Now, what about the CCCFA? We just see things normalizing a little bit to the way they used to be a few years ago. So expect top-ups, interest-only requests to get a little bit easier. Expect less scrutiny on the actual bank statements and things like that when you're trying to do a home loan. So that's all welcome changes. Now, I think one change that I think many commentators might not have talked about, which actually does impact how much you can borrow, it's actually the tax. So I'm talking about interest deductibility, which is back on for investors, and also the tax brackets. So some of these do actually have an impact on the bank servicing calculators. So we're starting to slowly see that feed through, and I expect more and more of that as well. Now, let's do a little bit of a deep dive into the monetary policy statement, which is a document which is available on the Reserve Bank website. They released it as they made their OCR announcement in May. Now, what's changed? Why aren't we seeing lower interest rates yet, or substantially lower interest rates? Well, they did kind of change their track of the OCR. So they've actually kind of said, well, it might be a little bit higher for longer, or stay higher for longer. Which only a smidgen though. You can see in that graph there the February MPS forecast and then the May. Why? Well, they feel like CPI, inflation, is a little bit higher than they would have liked it to be. So again, if you look at CPI inflation here, their target range is between 1% and 3%, or 2% midpoint, as people like to say. May MPS here, you can see a slight variation to the February MPS projection there, or the forecast. Not a lot in it really. Where is that coming from? You'll hear the central bank talk about tradable inflation and non-tradable inflation. Non-tradable inflation is basically just that. We can't trade it away, so domestic inflation. And that's where they're a little bit worried, because if you look at that pink line is basically a higher than what they were hoping for in February, right? So that's tracking a little bit higher, and that's where I guess this stronger language came in, even though there was no change in OCR. I'm guessing the wholesale markets took that as a little bit of a strongly worded monetary policy statement, although I know that the interview afterwards that the committee of the Reserve Bank did ease some of these pressures. Because surprisingly, in this monetary policy statement, they did actually mention that the committee had considered for a moment increasing the OCR, which was interesting. I think that was a very interesting thing to say in the monetary policy statement. I wasn't expecting that at all. Couple of things that could change the track, though. The New Zealand dollar. I don't think we think about this a lot, but a lower New Zealand dollar exchange rate than assumed at the time of the February statement will lead to higher than otherwise prices for our imported goods and services. So a stronger New Zealand dollar is good, and I feel like there are things on the horizon which is pro-New Zealand dollar, such as, I would say, export type policies, and also policies which generate money coming into the country. Now, apart from that, the only other thing I think the committee did mention, the committee noted that the signalled lower government spending is currently expected to continue contributing to weaker aggregate demand. Nice. However, any likely changes to government spending or private spending due to proposed tax cuts are not in the May monetary policy statement. So, projections. This timing difference poses an upside risk to the forecast of aggregate demand, the relevance of which for monetary policy will be clearer over coming quarters. So yes, there could be a bit of change on how that plays out, and we're talking about the tax cuts, but also at the same time the government basically reducing the workforce and trying to cut down its spending. Interestingly, what was also mentioned here was bank funding costs are expected to increase over the forecast period as funding sources normalize, with revision to higher cost wholesale and term deposit funding. Higher funding costs in turn are expected to maintain upward pressure. So again, guys, that's really interesting to me, because I know that overall what was mentioned was capacity pressures in the New Zealand economy have eased. So I think that's like we've got the workers, that a lot of people that have come in, but interestingly, this monetary policy statement still had some strong language to basically say, hey, right, slow down, don't go out and spend a whole bunch of money. Not that I know anyone that is, really. It does feel a bit tight out there. Anyway, as always, if you're thinking about interest rates and things like that, you do need to consult a financial advisor like myself to really kind of fine-tune things to your own personal circumstances, right? Because obviously I do always get this a lot. Clients say, hey, should I fix for long? Should I fix for short? What do you think is going to happen? Well, here's one tip. If you see some pressure on your income in the coming months, or sometimes fixing short can be a little bit risky, because if you can't afford for interest rates to go up, then you can't afford for interest rates to go up, right? That doesn't change that. Consider then some longer term fixed rates, or even hedging it, right? So, but again, it's just an illustration that it is important to consider your own personal situation. Throw it up in front of a financial advisor like myself to see what we think on the overall scheme of things. Thank you for watching. Hamish from mortgagesonline.co.nz.